PMI, or private mortgage insurance, is something you might be familiar with if you currently have a mortgage loan. It's something I'm certainly familiar with, and today I want to show you a very easy trick that can help you take that PMI and potentially turn it into tens or hundreds of thousands of more money than what you're currently using it towards. So PMI is something that normally happens when you buy a new home, and let's say you put less than the 20%, which would make that loan a conventional loan. And so what has to happen is the bank needs to protect themselves from you defaulting, right? You're sort of a more risky borrower. You're not putting enough down to show them that, hey, you have what it takes to handle the loan. So they're going to impose a value on you. They're going to impose sort of like a tax almost on you, a sort of insurance policy on you called a PMI, private mortgage insurance. I'm bringing out the notepad today because I have a lot to talk about, and I want to make sure I hit my points right. Okay, so if you stop making payments on your mortgage, a little bit of an insurance they have here, typically this is between 0.5 percentage point to 1.5% of your total loan. So let me give you a little bit of an example here. I bought my house in 2021, and at the time I was in my 20s. Now, most people that are in their 20s probably don't have 20% to put down on a house, especially in today's economy. I, to be completely honest, got a little bit lucky because at that time, COVID was still sort of hot in the news, and I think mortgage rates were all over the place. So I was able to lock in a lower mortgage rate, but I still needed to put only 3% down. It was a very low amount, and I did need to incur a PMI. So I'm going to give you some examples as I go along the way, but here we go. Here's the first one. Imagine your home price is $300,000 and you put 10% down. Okay, that means the loan amount you're going to get is $270,000, and with that PMI being between 0.5 to 1.5% of that loan amount, let's go 1%, you're going to be paying $2,700 a year on that PMI. Okay, mine comes out to be about $2,100 a year, or about $170 a month. I'm going to show you an image of that PMI amount right here directly from my statement that I get from my mortgage lender, so you can see exactly what it is that I'm paying and what it is I'm exactly about to teach you right now. Now, the cool thing about PMI, it's something, well, to be honest, there's nothing really cool about PMI, but something about PMI is typically when you reach a certain threshold, that typically tends to be about 20% to 22% of equity in your home, your mortgage lender will typically have it removed. Or sometimes you can even call it, let's say, if your home value has appreciated, and you can have it removed early. It's something I'm trying to do because, again, I sort of bought at a lucky time, let's say, when home prices were somewhat lower, mortgage rates were a little bit lower, so I'd like to think my house has appreciated in the last 4 years. So this is something I'm actively trying to do. I'm going to sort of walk you through this process. To be able to have this removed early, you typically have to go through a formal appraisal process, something that your mortgage lender will help and guide you through. You typically call them, they will give you a list of approved vendors, approved appraisers, they'll come to your house, they'll do the appraisal, and then if your home has appreciated enough that your equity sort of balances out and falls within that range, you can potentially have it removed. Here's another example. Let's go back to that $300,000 loan, right? That $300,000 house. Imagine your home now appreciates to $360,000, but that original loan is $270,000, right? Now you have actually more than 20% of equity in your home because of that appreciation that has happened. So if you call the mortgage lender, you give them this new appraisal, they'll be able to see that you have more equity and you'll be able to have that PMI removed. So all this talk about PMI, now you might be wondering, okay, so I have the PMI removed, and what can I use it for? Well, here's the really cool part. People typically don't like PMIs, right? PMIs are not a great thing. It's dead money. It doesn't build equity, and it only protects the lender, but once you have it removed, it can be a superpower. Now, I'm going to be making videos more on this channel about savings, an easy way to identify savings, but a PMI, especially for those that currently have it, is one of the easiest ways to save. This is the mindset that I want you to adopt. You've already been used to paying this PMI, right? Currently, I am already used to paying that $170 a month for that PMI. It's money that I don't see. It's money that I can't do anything with. It's just coming out of my pocket into my mortgage every single month, right? If I start getting that money back, there's two ways that I can see it. I think, I don't have exact stats for this, but I'm willing to bet that most people get that $170 back, and now they're thinking, oh man, I'm $170 a month richer. I can go, maybe I can buy a new car, or I have a little bit more that I can use toward a car payment. I'll take my wife out to a nice dinner, and I'll start eating out more often, or I'll go on that nice vacation. But that's not the way to think about it. Obviously, maybe you want to treat yourself to one dinner, maybe there is a nice little purchase you want to give yourself, but the long-term thinking is what I want you to adopt. Think about that, what that $170 a month unlocks for you. It unlocks, in my case, $2,100 extra that I can invest annually. In the original example I gave you with that $300,000 house that you put the 10% down payment on, that 1% PMI payment equates to $2,700 a year. So it's $2,700 a year that you can invest. And this is truly where the magic comes in, okay? I'm gonna be making a video about index fund and mutual funds and ETFs, but broadly speaking, we're going to invest that money into an index fund that tracks the S&P 500. Now, there's different funds that you can invest into, whether you're on Fidelity or Schwab or Vanguard. So on Fidelity, I like to invest in FXAIX. If you're on Schwab, you might do something like SWPPX, or if you're on Vanguard, you might do something like VFIAX or VOO. The point being, you can start doing automatic deposits into these funds. Maybe you do it monthly, or maybe you do it annually. So let's assume that you invest this, in my case, $2,100 at the end of the year for the next 35 years, okay? Why do I pick 35 years? Well, I'm 32 years old right now, and I'm planning on retiring at full retirement age. Frankly, I love the work I do, and at this point, I'm not interested in FIRE. I'm not interested in retiring early. I enjoy the work I do. I'm challenged. I love my coworkers, and I can see myself continuing to do this job until I'm 67 and maybe even longer. To be honest, I've worked with people in the same company that are just as old, and they've been doing it for that long, so it sort of speaks volumes about the company and the people that I work with. So I see myself doing this long term, but 35 years, okay? I'm gonna show you a website now that I use based on one of my favorite resources. They're the Money Guys. Now, I'm not affiliated with the Money Guys at all. The Money Guys are a great financial resource. It's a great YouTube channel that I watch. It teaches you so many different things about finances, and it's sort of inspired me to create my own channel. But on their website, they have a list of resources, one of those being a compound interest resource. So what I'm gonna do is I'm gonna plug these numbers in, and I'm gonna show you the scenarios for 3 different things, okay? 3 different, let's say, return on investment averages. Now, I went on Fidelity, and for FXAIX, I saw that the return on investment for the lifetime of the fund is about 11%, okay? So if I plug the numbers in, I have $2,100 invested annually at the end of every year. I assume an 11% return on investment for the next 35 years, assuming I start at 0. My return on investment can be $820,000 at the end of those 35 years. You hear me correctly, $820,000 at the end of 35 years, assuming that 11% return on investment. Now, these are non-inflation adjusted numbers, but of course, the website will give you this non-inflation adjusted number, and then you can do the math to sort of figure out what that value will be. But think about the power that unlocks, okay? If you do some rough math, for example, let's say you just take that $2,000 extra a year and just pocket it for the next 35 years. That's gonna give you what, $70,000? You can either have $70,000 at the end of 35 years, or you can have $820,000, okay? I don't know about you, but I'd rather prefer the $820,000, and that's the secret to investing, okay? This is what a lot of people will do. They will find a hole in their budget, they'll find an opportunity where they can save money, but instead of investing it, they instead use it for something else that is not gonna give them any money back. If you've already been spending that money, let's say you've been spending money on subscriptions or coffees, and you know, a lot of people will say, oh, the coffee is not gonna be the thing that gets you to the next level, that's not gonna be the thing that makes you a millionaire, but I promise you, all these little things add up. $5 here, $10 there. If you can find a way to remove that budget, don't go just spend it on something else now. It's like, okay, I won't spend money on coffee, but I'll just start going to like a new place to eat every weekend, which will probably even cost you more, right? Just take that money. You're already used to not using it for anything useful, so you might as well put it to something useful, and you can put it into investments. Let me go now back and give you different scenarios. If I take that same $2,100 and I get a 9% return on investment, so different ranges here, we're talking about $494,000 at the end of these 35 years. Similarly, if it goes up, right, let's say 13%, we're talking upwards of $1.3, $1.4 million at the end of 35 years. What I want you to do is I want you to go on the Money Guy Resources page, and for your numbers, do the same thing. Maybe right now you are a 20-year-old with a PMI, someone in their 20s, maybe someone in their 30s, maybe someone in their 40s. Think about how long you want to invest your money. Maybe it's 20 years, 30 years, 35 years like me. The website makes it very easy for you to alter these numbers so that you can figure out exactly what makes sense for you. But the point being, simple savings like this can give you so much in the long term. So PMI removal is something I'm very, very excited about. I've actually already called the mortgage lender. I have an official document from them that they have to send out an appraiser for me to use. They'll appraise the house. Hopefully it'll come up above the number and I can have it removed. And guess what? I've just given myself effectively, hopefully, $820,000 that I'll be able to use at full retirement age. Okay, the power of compound interest and compound gains is so real, and that's exactly what it is that I want you to take away from this video. So again, I'm going to be making more videos on investing in general and finding out these holes in your budget that you can use to multiply your wealth over the next several decades. The PMI thing is just something that I found to be so useful because when I first started my career, I had student loan debt. That was like a huge area for me to get a return on investment in and invest, okay? I was paying $500 a month on student loan debt, and once I removed it, that's effectively $500 extra I'm getting a month that I can use for anything. And then I went to my car, so on and so forth. I'll make more videos about this, but again, the PMI is such an important thing, specifically for people that own homes. So let me know in the comments. Do you currently own a home? Do you currently have a PMI? You can imagine that for people that have higher mortgage loans, the PMI will be higher. So imagine, if maybe for some people, that yearly amount equates to $3,000, $4,000 of PMI. Imagine what you can do with all that money reinvested in something like the S&P 500. And now, of course, other people might invest in something else. Depending on your risk tolerance, you might be able to invest in something a little riskier that can potentially give you higher returns. Again, I just want to put this in your head that if you invest in the right things at the right time, with the right risk tolerance, you can get so much more money back. And that's really what I'm excited to talk about today. Again, this is so exciting for me because I am passionate about finances. I'm learning alongside you all. I'm just someone that started watching videos, reading articles, doing basic research that doesn't take too long, and sharing this new knowledge with people that are interested. And that's what really excites me to just keep doing more of this. So if it's something you're interested in, make sure to leave me a like, make sure to follow me, ask me your questions. I'll do my best to help you. And with all that being said, I hope you all have a fantastic Wednesday. I sure will. And I will see you all next time. Later.